Welcome, real estate investors. Thank you so much for joining me today. I really appreciate your love and support that you're giving me. And if you haven't done it already, please like, comment, and subscribe on this video and my channel. That helps you out. This helps me out. It helps the whole world out. The activity is what creates the economy. And here we go. We're creating the economy just now. So thank you so much. Today we have a really great thing that we're going to cover. We're going to cover the first steps of analyzing a deal called Pendleton Court Apartments. And I'll show you what I do in my three-step process. And then in later videos, we'll finish out the steps. And if everything's successful, and if I move forward in completing the acquisition and then doing the repairs and then reselling the property, there's going to be a lot more videos related to just this specific deal. So here we go. This will help give you an idea of what I do in order to quickly look at apartments and figure out if it's a good deal, and then going through the further analysis to make sure it's a good deal, and then figure out what I want to offer, and then go from there. So here we have it. So on the right side here, we have Pendleton Court Apartments is the listing. It's listed for $1.95 million. It's 78 units. It's in Memphis, Tennessee. Here's some pictures. I'll show more pictures in a little bit. It's a value add opportunity. The one thing to keep in mind is they have a lot of details about the cap rate upon exit after repair costs are done. The total rehab budget is expected to be $1.5 million. So that means you're going to be in for the property at $3.5 million. So that's 1.95 purchase price if there's no negotiation, and then $1.5 million for repairs. So then the total cost to buy the apartment or to get into the apartment is $3.5 million. It's a 9% exit cap rate. And yeah, so and to keep in mind that the numbers that we are presenting here are pro forma numbers. So when you look at the deal more in the offering memorandum and the more details, there's only 6 units rented out of the 78 right now because there's extensive repairs, which we'll go over the pictures. And so all of these numbers that are stabilized are based on a pro forma, so it's not actually what the property is currently doing. That's key to keep in mind because some people can lose their shirt by buying properties based on pro formas because it's not actual real life. So you really don't want to buy off pro formas if you can. You want to buy off of actuals, but in some cases it makes sense to buy off of pro formas, and this is one of those cases just because it's such a great deal that you can. There should be some wiggle room in the purchase price, right? So we'll see what happens there in the future videos. But it's a building class C, and there we have it. So let's take a look at some pictures. Here's some pictures of the units outside. There's 2 different buildings. There's a white building, there's a red building. Outside looks pretty good. Maybe there's some landscaping that needs to be done. It should be some minor landscaping. Maybe that's a manager's office. Here we go. Boom, boom, boom. There we go. Here's some inside units. You can see there's just a lot of stuff that needs to get done in these units. Just some crazy amounts of repairs. The kitchen just nasty, looking very nasty. There's a bathroom. Here we have some other places. There we go. There's another bathroom, just holes in the walls. Just really, really not good. Yeah. So as you can see, the $1.5 million for repairs is just, and that's what it is. This is a value add property, right? So I'll just give you an idea of, here in the next steps of how I came across this property, and then, some analysis just to see if it's worth, moving forward, which it is, which is why I'm covering it right now. So there are some other pictures. You get the sense. These are just, not great stuff. Boom. There we go. There we go. Yep, here we go. Oh, yep. See, some were worse than others. That's pretty bad. It's pretty bad. Pretty bad. Pretty bad. All right. So there we have it. Okay. So my first step I did is I created a quick tool analysis tool that I show here on the Excel document. Now this is really special because what I wanted to do is instead of looking at deals one by one, going through my quick calculations to see if it's worth the deal, you can spend a lot of time by clicking into a property, going through typing in the numbers, see if it meets your requirements or not. I wanted something, an easy grid that showed me like how to analyze these properties in a quicker way. So I came up with a formula by using the cash on cash return formula and the debt service formula. And I came up with a bigger formula that incorporates the two that shows me in this grid that tells me based on the purchase price and the average rent per unit, how many units would I need in order to meet a specific cash on cash return. So as we can see in the inputs right here, we have a average rent, the revenue per unit that we just have for $700 listed. Price is $5 million. Expenses is 50%. That means net income is 50% of the total gross collected rents, which is the average rent times the number of units. Debt inputs here, down payment 25%, interest rate 8% based on current lending standards, loan period 30 years, cash on cash return is 15%, and a debt coverage ratio is calculated at 1.6. When you do this analysis based on the equation I came up with, depending on these inputs, which are in orange or yellow, the debt coverage ratio is the same for everything in the grid. So that's just something to keep in mind. That's why it's a calculated number versus calculated for each one. Okay, so the equation, as you can see, is right here. This is a nasty equation. Look at that equation. We're not going to go over it, but trust me, it works. I've done it many a times to double check. Over the top columns here, these are the purchase prices going from $500,000 to $5 million. Down here on the left side are the average revenues, average rents per month. So $500 up to $3,500 per month. This line right here is the line of basically tells you it's the line because $1,500 roughly is the median rent, average rent across all apartments across the United States of America. So it gives you an idea of, generally speaking, in a marketplace, if it's above that line, then you have a better chance of meeting that because it's the median rent for all apartments across the United States. So that's really good. But some of these, higher rents, these are like Class A, apartments, and they obviously get more expensive. But $3,500 is a pretty good limit. The red boxes are just any apartment, any number of units that's over 50. So again, and let me explain this correctly. This grid tells me based on a purchase price and an average rent per unit, how many units would I need at those numbers to hit a 15% cash on cash return. So if I purchased a property for $500,000 and the average rents were $500 per month, I would need 23 units at those rates in order to hit a 15% cash on cash return. So this is a really quick way for me to analyze properties. And I'll show you how I use it with Pendleton Court Apartments and how I found this deal. So what I did is I went on loopnet.com, and there's many ways to find deals in the marketplace. And I'll be covering this all the ways in a future video later down the road. But I just use LoopNet because it's the easiest way to analyze deals and get into the marketplace and start doing some work. And you can find great deals. Like I found a great deal off of LoopNet. So why spend any more effort if I found a great deal, right? And so what I did is I went there and I searched for multifamily properties all across the United States. I put in a purchase price of $5 million or less, and I had the number of units at 50 units or more because I really want to be at a 50 unit or more in order to buy properties, and that just helps verify that I have enough money for property management, professional property management, and it de-risks your investment the more units you have. So 50 units was my limit for that. And what I did is I said, okay, so I go through each property one by one. I sort the list from least to greatest, and I go there and I say, okay, given each one, what's the purchase price or the total cash outlay price? Say it was $2 million, and then how many units was it? Say it was 50. That means it's right between this 750 average rent and $1,000 for average rent per month. And so if I had a 50 unit at $2 million, then that means I'm very close to my I'm very close to my 15% cash on cash return, assuming that the average rents in that area are between $750 and $1,000 per month. So I use this as a gauge. I go to the purchase price, and I go to the number of units, and I go over to the average rents, and I say, does that make sense for this specific property? So Pendleton, let's take a look at that. It's listed for 1.95, but with a 1.5 million repair costs, it's the total cash outlay is 3.5 million. So I go to 3.5 million outlay. It's 78 units, which is between these two numbers right here, and that is between $1,000 and $1,250 per month. Now, given based on the offering memorandum, they say that after the repairs are done, the average rents are anywhere from $950 to $1,150 per month. I have to vet this, right? We're going to talk about that in the next step. Future steps, I'm going to go do that. But say that that was the case, then we're right in our ballpark. We're right between the $1,000 and $1,250 a month, which is exactly where the units lies. So that means we're right there in the sweet spot. And a $3.5 million purchase price and cash outlay for repair values at a 78 units. And if we got maybe like $1,100 a month rent, then that we would hit our 15% cash on cash return. So great. This is a great deal. And so by using this grid, I just quickly look at stuff. I go, does that make sense? Okay, it looks like a good deal. And so out of the 15 to 20 properties I looked at in the list, there was only two that looked good, and this one was the one that looked the best, right, to me. So this is the one that I wanted to move forward with. So that was my first step, using this calculation grid to figure out ballpark, does it look like a deal that I want to invest in? Great. So it does. Okay, perfect. So step two is actually running the numbers, given the numbers they give me, to see how it actually works out. So this is what step two looks like. I used Excel here to do my analysis. So it takes the net operating income, which is a pro forma number based on this offering memorandum. They think that it can, after stabilized and renting all the units out, it can generate $467,037 a year in net operating income. That's our taking out expenses. The price is 3.5 million again. Remember the 1.95 million purchase plus the 1.5 million for repair costs, and that gives me a debt service of $308,000. That would be a cash on cash return of 13% and a debt coverage ratio of 1.52, which is great because that's what we're looking for. When we're getting financing, we want a debt coverage ratio of at least 1.25 to meet in current lending standards. In more lackadaisical standards, it's like 1.2 and stuff like that, but in more stricter requirements, it's 1.25 debt coverage service ratio. And so by doing a step two analysis, I go, okay, if I were actually able to achieve this net operating income based on the purchase price, I'd be receiving a 13% cash on cash returns. And in fact, when I did my own analysis and numbers, I actually received a higher net operating income than what they projected in the pro forma. So that's something to keep in mind as well. And as you can see, if we calculate this up, maybe if it's $500,000, $550,000, then we would have a cash on cash return of 20%. So you can see as for each additional increment, the numbers change. So we're going to go back just because that's what the pro forma is. Now, step two, these are pro forma numbers. I mentioned that you don't necessarily want to buy a property based on pro forma numbers. You want to buy based on actuals. But if the deal is good enough and the spread's good enough, especially on a very intensely value add property like this, pro forma numbers are fine. You just negotiate based on what your analysis is, and you need to make sure that you have enough money to cover debt service in the meantime as you're repairing the units and then before you can rent them out fully, because you're going to be obligated to pay that debt service back even when you're not making money. And in this case, there's only 6 units rented out currently as actual numbers at an average rate of $325 per month per unit. So that's not that great because, as you can see in the pictures, these are very, very problematic units. They need a lot of repair. So that's step two. Now, step three is going over the full analysis of listing out what the seller says and what the offering memorandum says, what your analysis says, puts all the debt and the first lien holder, so a traditional mortgage and a secondary lien, so like a seller financing, which one of the great great things about this property is the seller is willing to seller finance, which is a great kudos. And I just got off the phone with my lender, one of my lenders this morning, and they're open to seller financing. So that's great. And that's great. So I'm not going to go over step 3 in this video. We're going to go over step 3, the full analysis, later down the road in a later video. We've already gone through a full analysis. If you look at video 15, analyzing a small deal, that's an example of the full analysis software. So if you want to click over to that, I'll probably link that video in the cards at the end of this video, and you can go check a look at that. And so there we have it. There's step 1. There's the quick analysis. There's step 2. There's the short analysis, with the actual numbers. And then step 3 is the full analysis. Now, what also comes with step 3 is verifying the numbers that are told in the offering memorandum. So you want to verify the average rents in the marketplace. You want to get bids for repair costs by some contractors, some general contractors in the area, 2 or 3 general contractors in the area. And these are some of the steps that I will be taking forward today moving on, that I will cover and back cover in future videos so that you can stay up to date with me on this deal. So I hopefully you like this deal, and hopefully we keep analyzing this deal all throughout the steps. If this is a deal that becomes successful and I buy this property and start doing repairs and everything, then you'll see videos across all of the steps until reselling the property 2, 3, 4, 5 years from now. So this is going to be a nice series. Who knows how long the series? Maybe I don't get my offer accepted. Maybe I can't close on the deal. Maybe something crazy happens and we have to stop the series at some point. But hopefully it goes to fruition, and you see all the steps that go into doing a deal. So happy apartment hunting. Your multifamily real estate investment expert, Connor Scott McCarl, out.